Imagine driving a car blindfolded on a winding road. You might feel the thrill, but the risk, unimaginably high. Running a business without understanding your cash flow is much like this. It's the lifeblood of any company, big or small. And for many cash-based small businesses, mastering cash flow could mean the difference between thriving or failing. Today, we're diving deep into cash flow statements, what they are, how to read them, and most importantly, how to use them to make better business decisions. What is a cash flow statement? A cash flow statement is one of the essential financial reports for any business. It stands alongside the balance sheet and income statement, giving a clear picture of your company's cash movements. In simple terms, this statement captures how money flows in and out of your business over a set period. It's usually divided into 3 sections. Operating activities. This includes cash earned or spent in core operations, like sales revenue or supplier payments. Investing activities. Here you'll see cash tied up in long-term assets such as equipment or real estate. Investments that aim for future growth. Financing activities. This section covers cash exchanges with investors and lenders, such as loans or dividends. Understanding each section can give you a snapshot of your business's financial health. This is especially vital for businesses running on cash basis accounting, as it shows the actual money on hand to keep operations going. Why is a cash flow statement important? The importance of a cash flow statement cannot be overstated. Here's why. Checks liquidity. Liquidity is your ability to meet short-term obligations. This statement shows if you have enough cash to cover everyday expenses, from payroll to rent. Shows financial health. Unlike an income statement, which can include non-cash items like depreciation, the cash flow statement focuses solely on actual cash. It provides a true view of your cash position, informs investment and financing decisions. Whether you're thinking of expanding, taking a loan, or paying dividends, your cash flow statement should be your guide. In fact, a report from QuickBooks reveals that 82% of business failures are due to poor cash flow management. This statistic alone highlights how crucial it is to understand and monitor your cash flow regularly. How to read a cash flow statement. Understanding a cash flow statement may seem overwhelming, but breaking it down by section can make it clearer. Operating activities. This part shows your cash inflows from customers and outflows to suppliers. It helps you see if your daily operations generate enough cash to cover expenses. Key components here include net income. This is your profit after all expenses. Depreciation and amortization. These are added back since they don't involve actual cash. Changes in working capital. This includes inventory and accounts payable changes. A positive operating cash flow is ideal, showing that your core activities generate cash. A negative flow here. That could be a red flag needing immediate action. Investing activities. This section deals with long-term asset transactions, things like buying or selling property or equipment. These investments are vital for future growth, but may require significant cash outflows. Questions to ask. Are you investing too heavily in assets too soon? Or are you selling assets for liquidity? This could indicate financial strain. Financing activities. Here's where cash exchanges with investors come in, like issuing stock, taking loans, or paying dividends. A business constantly raising money through financing may face liquidity issues. This especially applies if the core operations aren't generating much cash. Using a cash flow statement for business decisions. Once you understand your cash flow, the next step is leveraging it for better decision-making. Let's explore a few practical applications. Planning for growth. If you're considering expansion, a positive cash flow from operations means you're likely in a stable position to invest in new projects without resorting to heavy debt. Checklist. Are your operations consistently bringing in positive cash flow? Do you have enough reserves to invest in growth? Managing debt. Reviewing your cash flow can help you assess whether your business can manage more debt. Pay attention to your financing activities, where current loan repayments are tracked, to decide if additional debt is manageable. Avoid taking on new debt if your operating cash flow is consistently negative. It could only worsen your financial position. Maintaining operational efficiency, positive operating cash flow, but no profitability, it may be time to revisit costs, streamline processes, or renegotiate supplier terms. Checklist. Are you overstocked with inventory that isn't selling? Is too much cash tied up in accounts receivable? Avoiding cash shortfalls. A key benefit of cash flow analysis is spotting potential shortfalls before they become crises. Regular cash flow checks can help you avoid situations where you're out of cash. The Small Business Administration reports that most businesses hold only about 27 days worth of cash reserves. Not much of a cushion, is it? Common mistakes in cash flow management and how to avoid them. Many small business owners make common cash flow errors that can lead to trouble. Here's what to watch out for. Ignoring seasonal fluctuations. Many businesses face ups and downs throughout the year. Failing to account for these cycles can mean liquidity issues when business slows down. Use historical cash data to forecast low cash periods and build a buffer for these times, focusing only on profit. A profitable business isn't always liquid. Profit doesn't mean much if cash isn't available for immediate expenses. Track cash flow alongside profit to get the full picture, not keeping a cash cushion. Unexpected expenses or dips in revenue can deplete reserves fast. A good rule of thumb: keep 3 to 6 months worth of expenses saved. How to improve your cash flow. If your cash flow isn't where you'd like it to be, here are strategies to strengthen it. Speed up invoicing. Late payments hurt cash flow. Consider offering early payment discounts or automated reminders to prompt timely payments. Use accounting software to streamline invoicing and follow-ups. Negotiate better terms with suppliers. If cash outflows are tight, try renegotiating supplier payment terms to extend by a couple of weeks. Checklist. Have you recently reviewed supplier agreements? Can you extend terms or secure bulk discounts? Cut unnecessary expenses. Reducing costs can often improve cash flow. Look for areas where you can cut back without sacrificing quality or customer satisfaction. In closing, managing cash flow is crucial for the sustainability and growth of any small business. A cash flow statement is one of your most powerful tools. It gives you an in-depth look at your company's liquidity, empowering you to make decisions that drive growth, manage debt, and maintain operational stability. If this video helped you understand the value of cash flow statements, give it a thumbs up, subscribe to our channel for more financial insights, and let us know in the comments how you're using cash flow to drive your business decisions.